Derek asks, what is the advantage of using that strategy you just explained regarding 450 in 1 year? Oh, the key advantage there, Derek, is that you're able to either get money into the concessionally taxed superannuation environment. If you put money into super and then roll it to pension phase, there's no tax on the money in the fund, as long as you're earning less than $100,000 in the fund. There's no tax on the money that you draw from the fund if you're over 60. And if you've moved it to pension phase before 1st of January 2015, it's going to have potentially has some Centrelink benefits as well. So getting chunks of money out of your own name or other structures into super can have benefits on those tax, Centrelink, on those perspectives. So really the bring forward rule is just enabling you to put that money in all at once. And it's particularly relevant if you're turning 65, because once you turn the financial year after which you've turned 65, your contribution limit goes down to $150,000 per annum. So if you're looking at retiring or finishing up work and you've got a chunk of money, you need to sell an asset, for example, that's going to incur some capital gains. It's best to do it after you've finished work, so you don't incur too much of a gain. And then you want to put a lump sum into super. That's the scenario that it can be useful. The other scenario that it can be useful is that if you've got a large difference in ages between spouses, and one spouse is going to reach pension age prior to the other spouse, and what you can do is hold as much of your assets as possible in the younger spouse's name in the accumulation phase of super, and those assets are not tested from Centrelink's perspective. So that's another scenario where you might use that $450,000. So you cash the money out of the older spouse's name, put it into your bank account, and then put it into the younger spouse's name. And that might be a reason for using that $450,000 limit. And the other scenario is sometimes what we call a cash out recontribution strategy, where it doesn't generally benefit you individually or your spouse, but it benefits your beneficiary should you both pass away. And it's a strategy called a cash out recontribution strategy. You pull the money out of super, put it into your bank account, and then put it back in again. And it just clears the tax components, which means that if the money passes from your super to a non-financial dependent on the event of your death, that they won't pay any tax on the money. So that's another use of the $450,000 contribution limit, which actually might go up to $540,000 or $630,000 in the coming years.